Hello everyone, it's Wednesday, January 28, and today we will analyze the charts for the euro and the British pound to identify potential market trends. On Tuesday, the US dollar extended its losses across the board. Yesterday's disappointing data revealed that US consumer confidence plummeted from 94.2 to 84.5 in January, seen as an indicator of a weakening US economy and a further dollar decline. Adding fuel to the fire, Donald Trump remarked that he is satisfied with the current situation regarding the dollar, claiming that he sees nothing negative about its decline. According to the president, the dollar is fine, the US economy is good shape, and trade tariffs are generating profits. The statements exacerbated the dollar's position in the market, leading to another major sell-off during the late US trading session. The strong bullish momentum has prompted investors to continue shedding the greenback in favor of other assets, including gold, which has already surpassed 5200 per troy ounce. Notably, Trump has repeatedly accused other countries of deliberately weakening these currencies to stimulate exports. His statement yesterday that he's unconcerned about a weaker dollar essentially signals to investors that they can keep selling the American currency. Moreover, escalating tensions between the US and the European Union over Greenland, threats of new tariffs against South Korea, increased pressure on Canada to prevent it from finalizing a trade agreement with China, and discussions or coordinated currency invention by Japan and the US. None of this fosters optimism or encourages traders to buy the greenback. Turning to today's macroeconomic calendar, it is relatively light. During the European session, traders may pay attention to the leading consumer confidence data from Germany for February. Later in the day, focus will shift to the Federal Reserve's meeting and its policy decision. It is widely anticipated that the US Central Bank will keep its benchmark interest rate steady at 3.75%, as the committee is likely to adopt a wait-and-see approach. Traders are not expected to receive any signals suggesting further rate cuts, especially in light of the current environment characterized by a significant decline in the dollar. The topic of inflationary pressures may resurface, and therefore the press conference following the meeting is likely to focus on economic prospects and labor market stability. Fed Chair Jerome Powell may indicate that while the situation has stabilized, it still requires vigilant oversight. If he makes remarks about inflation, the dollar could have a chance to recover slightly. However, if the Fed takes a more restrictive stance and does not hit at any rate reductions until the summer, the greenback will likely continue its bearish trend against risky assets. Now, let's move on to technical analysis. The 1-hour EUR USD chart suggests that long entries could be considered on a false breakout at 1.1973 and 1934, or on a rebound at 1897, aiming for a 35-40p move. Given the bullish bias, be cautious with shorts. Use the resistance level of 1.2027 and 1.2078 as areas to look for short entries only after a false breakout. Going short on a rebound would be relevant at 1.2135, targeting an intraday correction of 30-35 pips. As for the British pound, a false breakout at 37.82 or 37.45 would trigger a buy signal. Long entries on the rebound could be set at 37.09, aiming for a 30-35p move. For short entries, it is best not to rush into the market, but wait the price to stabilize in a sideways range within a broader bullish cycle. Short positions could be considered at 38.23 on a false breakout, counting on a decline to 37.82. A false breakout at the 1-month high of 1.3864 A major resistance level would present another selling opportunity, with sterling potentially sliding to 38.23 and even 37.82 as a part of bearish correction. Going short on the rebound would be prudent at 39.10, targeting at 35.40 pullback. Best of luck to everyone.